volatility, and I'll tell you all the talk about volatility and the increase, say, in the VIX, that measurement of fear in the stock market, has investors worried, very worried about their money, their future. But the truth is, I've said this before, and I've been saying this since we've been looking at these wild swings, our economy is doing very well. We are seeing improvement in fundamentals. We are seeing improvement in wages. And that's what's going to help us. It's going to help us a lot. Here's, by the way, Treasury Secretary Steven Mnuchin testifying on Capitol Hill.
I'm not overly concerned about the market volatility. I think the fundamentals are quite strong.
Does this have financial stability implications?
No, I don't think these types of moves, given how much the market has rallied, do have financial stability concerns.
Well, the administration has claimed credit for the markets going up. Are they going to claim credit when the markets go down?
Again, I think we'll still claim credit for the fact that it's up over 30% since the election.
You know, you heard Carolyn Maloney there saying financial stability, or asking that question about financial stability. Is it going to affect financial stability? And that's one that you keep hearing because, you know, you think back to 2007, you think back to 2008. That was a time when our very financial stability was challenged. We were in the middle of a credit crisis. And we are still, in some ways, suffering the effects from that credit crisis. But you also think back to, say, the year 2000 in the tech bubble. That was an asset bubble. It burst. We moved on. So two very different things. When you're talking about a lack of financial stability or any kind of credit crisis, that is something that is, in fact, very scary. But, you know, the market giving up a few hundred points here, a few hundred points there, even 1,000 points there, we can handle it so long as the rest of the economy is doing well. In fact, it's a normal thing to have happen. Joining me right now with reaction, Janet Montgomery Scott, Chief Strategist Mark Buccini, along with Fairfax Global Markets CEO Paul Dietrich. Do you agree with me, Paul?
I do. You know, the underlying fundamentals of the economy are as solid as I've seen them in years. And I know analysts have tried to come up with all sorts of screwy theories as to why we're seeing all of this volatility right now. You know, workers are making too much money, unemployment is too low, all of these sort of things.
All these things, by the way, are good things. Let's just remind everyone, these are good things. You want workers to make more money. You want unemployment to be low.
Yeah, and they keep saying, well, it's going to cause inflation. I mean, the small gains in earnings are just barely above inflation. They're going to have absolutely no effect whatsoever when it comes to inflation.
Oh, I want to stop you there. So are you telling me then the Fed's not going to be so aggressive?
No. I mean, look, during the 8 years of President Obama's administration, we ran up deficits of $9 trillion. And what was the result in terms of inflation? Zip. Nothing. You know,
yeah,
we're talking about... it is, but it had nothing to do with inflation. We just got to distinguish these things. For the long term, you don't want to do that. But in the short term, we have deflationary pressures all over the world. The rise in Asia and Asia manufacturing, that's deflationary. You know, you've looked for 3 months. We've had people selling the dollar. The dollar's been going down. That people are basically saying there's no inflation coming up in the United States.
Yeah.
So,
and by the way, the 10-year and the 30 year is barely 3%, and the 10-year is 2.84%. So, you know, yeah, they've moved a little, but money's still pretty cheap right now. Every
measurement you can look at, nothing is showing any inflation. I mean, people were talking about the tax cuts. That's going to add $100 billion. You know, we just added $9 trillion over the last 8 years. We haven't gotten any inflation. This is completely overblown.
Okay. And this is an interesting viewpoint to hear. I mean, I look at the market and the volatility that we've seen, certainly in the losses, Mark, and I say to myself, okay, well, this is probably healthy because we haven't had any inflation and we kind of need some inflation. I welcome 2.9% wage growth for people. And, you know, maybe we're getting back to some kind of normal where the hard part about deflation is that's a very, very hard thing to fight. And it's hard to, like, get people's incentives going, right? If they know they can buy something next year or 2 years from now and it might actually cost less, or money might be cheaper to borrow, then they're going to wait. And so I'd like to see us return to a normal yin-yang kind of relationship where, consumers and corporations feel that they want to do something now as opposed to wait. How do you think about inflation in this environment?
Well, I don't disagree with you, Trish. Basically what you explained, you can look at Japan as a prime example, a case study, in fact, for a period of 15 years or longer of endemic deflation and why their economy was so moribund, because that was the problem. The Bank of Japan didn't act fast enough and didn't act with enough largesse to stoke inflation and try to pull forward some of those spending expectations to revive economic activity. It's finally working there, by the way, but even then, they're pulling a long way toward trying to raise inflation up towards its price target of 2%. Same thing true here, though, in the United States. And I would disagree a little bit. I think there are plentiful emerging signs of price pressures, both in the manufacturing and services sectors, that is leading me to believe that while I don't suggest that we're in the midst of about to encounter imminent hyperinflation, I think what we're going to see is we're going to enter a period in which we're on a glide path of higher inflation that allows the Federal Reserve to believe they're on the path toward a 2% inflation rate that will embolden them to raise interest rates according to their forecasts over the balance of 2018. But at the end of the day, it'll also be good for businesses in terms of being able to pass along price increases, which is going to obviously reinforce inflation, but also in the form of wages, which is exceedingly important and very encouraging that we finally got a number of 2.9% out of this last Bureau of Labor Statistics report.
It's been basically 30 years since Americans have gotten a wage increase when you adjust for inflation. I mean, it's kind of disheartening stuff. Paul, also keep in mind, that was January's jobs report, so you were looking at what was going on in December, and that was before news of the tax cuts came out. And so now we have corporation after corporation saying we're giving bonuses, we're giving an increase in wages. You saw that at Walmart, for example. Does this mean that 2.9% is actually just the beginning? Could this number in the next jobs report be significantly higher?
Well, again, these are year-over-year numbers, and I think it may actually be a little bit higher. But, we have, 2% inflation, and we're talking about 2.9%. It's not enough to spur the kind of inflation that I think a lot of people have been talking about. And the Fed has already said they're going to be raising rates, but they have a guideline of 2.2%, and we're not even near that. Yeah. One could argue, if you take out energy prices, that inflation is actually less than it was a year ago. And I'm just not seeing in the next year or two.
Okay, so this means the Fed, moves, but perhaps less aggressively, and we're all able to adjust, which means equity prices will probably still do pretty well in that environment, Paul?
I believe so. 10 days ago on your program, I talked about how I thought that the market was overvalued, and I think that's the real reason that we've come down. We're about 11.1% overvalued as of last Friday when the market started to go down. I think we've got a little bit more further to fall. There are all sorts of academic studies that say that eventually, when trends get out of whack, that they revert to mean, and you get back to fair market value. I think this is great.
Yeah, you know what? And for all those people still sitting on the sidelines, it offers an opportunity for them to get in, for sure. Anyway, good to see you both. Interesting perspective from Mark and Paul. Thank you very much.